I guess we chose this topic today because we're seeing quite a lot of articles, a lot of pressure from our institutional consultants and clients questioning the benefits of active, particularly against the cheap alternative. Mark Twain famously said, never pick a fight with somebody who buys ink by the barrel. In the investment space, you could argue that an active manager shouldn't pick a fight with somebody who tracks indices for a living. Presumably, the passive manager has more time on his or her hands, and the active manager could ultimately lose the battle for public opinion. But I guess this presentation is not necessarily an attack on passive. There is an intellectual foundation for passive, which I'll run you through. And I do think it's a suitable investment strategy, particularly for small or unsophisticated investors, as well as for those investors that want to focus their attention on another aspect of the investment decision. So, for example, our asset allocation team that David and I sit on spend quite a lot of time looking for attractive asset classes. And when we find that attractive asset class, we may not have the time, the skill, or the inclination to go and pick the underlying securities. We just do the work and find the asset class, and often we can use an ETF just to replicate that asset class as opposed to actually selecting the underlying securities themselves. Setting the scene, let's assume for today that a retail investor can pick between two different kinds of vehicles. An actively managed mutual fund, or what we call a unit trust in South Africa. Here, effectively, a fund manager is actively managing a group of assets. So the Prudential Equity Fund would be an example of an actively managed unit trust. At the other end of the spectrum is a passively managed unit trust. This is a vehicle that simply tracks an index or a benchmark without the need for an active manager, and therefore is lower cost. In the US, particularly, as investors sought cheaper and cheaper ways of accessing the market, out of the passive space mutated effectively exchange-traded funds, which are similar but not exactly the same as a passively managed unit trust. As the name suggests, exchange-traded, these are vehicles that can be traded on an exchange like the JSE throughout the day, like any other stock. Whereas a unit trust is priced at the end of the day. What this presentation will hopefully highlight is that some of the original tenets of passive have been hijacked to effectively sell investors higher cost products. So while ETFs originally were constructed to be low-cost passive vehicles, we've seen a lot of them mutate to be higher cost, but also effectively not pure passive vehicles. And I'll spend a bit of time later talking about the growth in smart beta. At the same time, as active managers have faced competitive pressures from the passive world, we have seen a reduction in costs of active managers, and we've also seen active managers become more active as well. The other issue that my presentation will hopefully highlight is that you cannot take research that has been done in the US on the active-passive debate and simply transpose it onto South Africa without taking cognizance of the different market dynamics. So what are you or your clients effectively seeing when you read the financial press? Effectively, the oversimplified conclusion is because active managers in the US have done a particularly poor job of beating the benchmark, particularly after fees. All investors, irrespective of their asset class, their geography, or their circumstances, should effectively go passive. The truth, however, is that outperformance by active managers of the index is actually cyclical. So this is data provided by Goldman Sachs, looks at active US equity managers versus the benchmark, and effectively the conclusion is that outperformance is cyclical. You have periods of outperformance, 1990 to 1994, and again in the early noughties, followed by periods of underperformance. 2016 was a particularly poor year for active managers in the US. They underperformed the benchmarks by 3%, the worst year on record since about 1998. Okay, no surprise, therefore, that you're seeing quite an increase in the amount of articles being written around the benefits of active. Okay, however, it is incorrect, in our opinion, to argue that active will never outperform. Despite the fact that we've had now quite a prolonged period of underperformance of active versus passive, 35% of those US equity managers are still outperforming their benchmark after fees. And if we allow for the fees of passive, which are often ignored in the analysis, 43% of active managers are actually beating their median passive peers after fees. And then if we move into the multi-asset space, so sort of the balanced fund world, we actually find that bond investors, for particular reasons which I'll highlight a bit later, do a much better job actually of beating the benchmark there. Sort of 60 to 63% of managers are actually beating the benchmark. So this goes against quite a lot of the prevailing narrative that active actually fails to outperform. Okay, moving on to South Africa. I think the research in South Africa is quite poor and quite sparse. This is one particular example that I've chosen to highlight, mainly because in the world that we're living in, somebody writes an article, a second person then writes an article, refers to the first article, then gives the first article credence without actually looking at how the first article actually compiled its data. So this proclaimed scorekeeper took the 185 general equity funds in South Africa, compared them against an index, and came to the conclusion that after 5 years, only 23% of active managers in South Africa are actually beating the benchmark. What they failed to tell you is that each fund wasn't compared against that fund's benchmark, which presumably is what the manager is trying to beat, but effectively they created their own index and then sought to see if the 185 managers actually beat their index, even though none of the managers actually are tasked to beat that particular index. So that's as illogical as saying that because the Rand strengthened in 2016 and 68% of South African fund managers beat the S&P last year, South Africa must have the best fund managers in the world. Clearly, you have to check each fund manager performance against that fund manager's benchmark. And that's actually what we've sought to do. We've taken the 5 largest funds in the general equity category, as well as our 2 funds, and we've compared each fund against that fund's benchmark. Okay, green represents outperformance of the benchmark, red obviously underperformance. And our conclusion is almost diametrically opposed to the above survey. Effectively, 71% of these funds are actually outperforming their benchmark. Also, what is significant is that these funds make up about 43% of the assets under management in the ASISA general equity category. So we think that is actually quite representative of what this audience or other IFAs may actually be allocating assets to, as opposed to the above survey, which was based on a simple fund count. So a 50 billion fund effectively had the same weight as a 50 million rand fund. If we roll the numbers forward to May, so active managers both in South Africa and the US are off to a better start in 2017. Then effectively, over 1 and 3 years, more than 50% of the funds are outperforming, and effectively 80%, or effectively 6 of those 7 funds actually outperforming their benchmarks over a 5-year period. Okay, what has driven the shift to passive in the US? So this slide, courtesy of Morgan Stanley, shows outflows out of active managed funds and inflows into ETFs and passive funds. Okay, the key driver is obviously fees. Passive is cheaper than active, and that's been a key driver of the shift. The other big drivers of the shift is, as Peter will allude to a bit later, is investors chasing a bit of past performance. Passive has outperformed active in the last 5 years, so investors are allocating money to the previous winner. And the other issue is taxation. ETFs in the US have a tax advantage over unit trusts in the US, and that is also a big driver of the shift. In South Africa and Europe, there isn't that same tax arbitrage. ETFs are taxed exactly the same as unit trusts. So whereas we might see a shift towards passive in South Africa, we don't think the shift will be as pronounced, given that there isn't this tax advantage of ETFs over unit trusts. I want to spend a bit of time talking about the theoretical foundation for passive and how, in our opinion, this has been hijacked. So if we go back to the 1970s and look at the practicing fathers of passive investing, the likes of John Bogle at Vanguard, Markowitz and Sharp, the lecturers, the professors, their theory was effectively to hold the market portfolio. Effectively, all equities were to be held in proportion to their size or their market capitalization. And when they started theorizing, effectively the S&P 500, for all intents and purposes, was in fact the market portfolio. The question we should pose is, well, are investors actually holding the market portfolio? Okay, when we look at data of the ETF industry in the US, massive industry, 2.5 trillion of assets, just over a quarter of those assets are tracking the S&P 500. Okay, so the question has to be asked, why are investors not following the advice of the founding fathers in tracking the market portfolio? And I guess the challenge to the rational practice of indexation is profit. So while it may make perfect sense for you or I, who want US market exposure, to buy an ETF for less than 10 basis points, doesn't necessarily make huge sense for a financial services provider that is trying to promote passive, particularly those that don't have the scale of a Vanguard or a BlackRock to engage in effectively a price war. So what is happening? Effectively, what is happening is these providers are diversifying you away from the market portfolio into more esoteric products, more narrowly defined indices, commodity products, etc., all at effectively a higher cost. And that's why we argue that the original terminology of passive has effectively been hijacked to sell investors the direct opposite. Diversify away from the market portfolio at a higher cost. The original tenets of passive also argued that if you were holding the market portfolio, you would have less risk. Specifically, you would have less company risk. You wouldn't be overly exposed to any one company. And that is true of the S&P 500 in the US today. Okay, the largest company in that index, also the largest company in the world, Apple, only makes up 4% of that index. So you're not overly exposed to any one company if you're buying a tracker that tracks the S&P 500. Okay, then the same is not true if you look at a sort of a narrowly defined sector ETF in the US, or unfortunately for the purveyors of passive in South Africa. Here, effectively, the largest stock in these indices is sort of 25% of your index is made up of one particular stock. So rather than effectively requiring less risk, you're actually picking up significant company or idiosyncratic risk by simply tracking the index. Okay, in fact, in South Africa, to replicate that weight in Naspers in the US, you'd have to buy 16 of the world's largest companies to replicate Naspers' weight. So the conclusion that we draw from this is that we doubt that the founding fathers would have been so quick to advocate holding the market portfolio if the market portfolio was actually as concentrated as our index. Another way of looking at concentration is to calculate what is known as the Herfindahl-Hirschman index, which I show here on the vertical axis. S&P is not concentrated at all. The top 40 in South Africa effectively is the most concentrated index we could find in the world. What I've plotted on the horizontal axis is effectively turnover. Now, when the founders of passive created their theories, you would hold the entire market portfolio and there would be no need to trade at all, because you effectively held the entire market. What has developed is that indices only tend to track the largest, well, in the US, the largest 500 companies, in South Africa, the largest 40, mainly because it becomes quite expensive to replicate the tail of these indices, the small stocks. Also, ETFs require a lot of liquidity, so they want to concentrate their efforts only on the larger stocks. So there's an element of turnover as stocks come out of the index and go back into the index, and that requires trading, both by active investors and also passive investors. Okay, so in the top 40 in South Africa, we have a quarterly rebalancing. Some stocks that have fallen in value go out of the index, and some stocks come into the index. If we look at turnover, S&P has quite a low turnover. That's quite good for passive. Most of the academics argue that you should have a turnover less than 15 to 20% to be able to implement a good passive strategy. Just by point of reference, bond indices have very high turnover, and that's because bonds mature, and therefore new bonds have to be continually issued to come back into the index. And this is actually one of the reasons why bond investors, active bond investors, are able to outperform the passive benchmark, because there's so much churn in the portfolio. It actually gives the active manager the opportunity to effectively bet against the benchmark. And if you look at effectively where the South African market lies, it effectively lies halfway between a good passive vehicle like the S&P and the bond index. Again, in our view, the founders of passive wouldn't have been so quick to advocate holding the market portfolio if the turnover of the market portfolio was as high as our index. Okay, looking at unnecessary risk in equity indices, particularly market cap weighted indices. Effectively, an index like the top 40 holds the largest companies. So as a company becomes larger, the index holds a bigger and bigger weight in that company. The index, unfortunately, is a bit of a dumb vehicle because it can't tell you whether a stock is rising in the index because it's generating more profits or because its rating is getting higher or getting more expensive. So let's say data back in 2000, its rating got very elevated. The index just went and bought more and more data, never questioning the valuation of that stock. Okay, so if we look at history, you can see back in the tech bubble, the S&P became very concentrated in a number of very highly rated IT companies. In South Africa, at the top of the resource cycle, the South African index became very concentrated in very expensive resource counters. Okay, at the moment, we obviously have a very elevated weighting in Naspers as well. At these points, it would actually make sense for an investor to diversify away from the index and therefore to diversify away from a passive manager that is simply tracking that index and move away from effectively a concentrated bet. Okay, if you don't trust me, go back and look at the performance of the S&P 500 since the IT bubble. Effectively, it took the S&P 7 years to recover the losses post the IT bubble. Similar with the South African equity market, since the peak of the resource cycle in June 2008, the market effectively gave you 0 returns for the subsequent 3 years. There's also unnecessary risk in the creation of passive bond indices. You might question why is an equity manager delving into the bond space. I think it's quite important for the growth that we're currently seeing in multi-asset or balanced passive products. Okay, so you're buying a passive balanced fund. The bond component of that passive fund will track, let's say, the ORBI. But it's important to understand how the ORBI is actually created and is there any kind of risk in that. Okay, this is the ORBI as it stands today. Largely in government debt, 93% of the ORBI is government debt, with about 7% in SOEs, largely Eskom. Okay, but let's assume after a trip to a shebeen in Saxonwold, the Eskom board decides that it's going to issue a lot more debt to build a nuclear power station that it doesn't necessarily need. Okay, what would happen? The ORBI effectively would increase Eskom's weight in the ORBI simply because Eskom has issued more debt. You effectively get more weight in the index to those companies or countries that have issued more debt. And effectively, you would pick up a lot more risk. Okay, an active manager obviously could take the view of whether they wanted to follow that benchmark move or whether they wanted to stay in effectively more secure government debt at that point. Okay, and that's why PIMCO, the largest bond manager in the world, argues that in a purely passive world, you could effectively have resource misallocation. You would have the hard-earned money of retail investors being channeled into very highly levered borrowers. Okay, where do we see the value of active managers? So we don't believe you could have a market without active managers because active managers are responsible for collating a lot of information and reflecting that information in prices that you see quoted on the exchange. And this is particularly true where you have a company that comes to market and raises capital. Okay, so Life Healthcare listed in South Africa almost 7 years ago. And at the time, the investment bankers that were listing this company came around on the roadshow to investors like ourselves and other managers, arguing that they were going to list this company at between 14.50 Rand and 17 Rand. Life Healthcare at the time was going to make about R1 of profits. So this effectively implied that they were going to try and list the company on a P of 14.5 to 17 times, even though the market at the time was trading only at a P of about 12. Okay, following pushback from active managers, effectively they had to lower this range of prices, and Life Healthcare actually listed at 13.50 Rand in May 2010. And if you had held Life Healthcare for those 7 years, you would have earned a very reasonable 16.9% return. Okay, so where are we going with this? Well, we effectively argue that if there were no active managers, there's no reason why the investment bankers would have simply not gone with their initial price range of 14.50 Rand to 17 Rand, and effectively, if you had listed Life Healthcare at those levels, those would have been your sort of compound returns. Okay, a decline of 1.2 or 3.8% per annum over that period. In our view, active managers effectively forced the price down, and we were able to capture that return. You might argue, well, why do your clients have to pay active managers for this price discovery? Surely, if you had just bought a passive product, you would have got the same return. Okay, unfortunately, that's not true because, as I mentioned, the indices that passives track don't track the entire market portfolio as advocated by the founding fathers. They only focus their efforts on the top 40 companies, and Life Healthcare was too small initially to go into the indices. So a passive product effectively would only have held Life Healthcare in these golden bars. So only once the stock had rallied 250% and the P had gone from 13 to 24 times would passive effectively have included Life Healthcare in its composition. It then would have sold Life Healthcare here in July 15 and then re-entered again in September 16, just as effectively the price began to fall. Your passive return on Life Healthcare, which actually, as you can actually see, is not passive, but is actually following some arbitrary indexation rule of the JSE, would have actually been minus 6.5%. I want to spend a bit of time looking at our investment philosophy and process at Prudential versus smart beta. So smart beta is effectively a way of constructing a passive portfolio, but not just based on size, but some other metric. Often this is based on dividend yield. In South Africa, the Divi Plus is quite a popular passive portfolio. You can have other factors that screen by PE, etc. And what we are going to look at is how our process compares to Divi Plus, which is the largest smart beta product in South Africa, which simply selects those companies with the highest dividend yield, which seems to make intuitive sense, but it is quite a narrow lens, in our view, through which to view the market. Okay, how do you compare two companies that both trade on a dividend yield of 4%? So let's say they make 4 Rand of profits and their share price is 100. Okay, so the divi yield is 4%. Well, what if I told you that company A only makes 4 Rand of profits, whereas company B actually makes 8 Rand of profits, pays you out 4 and reinvests the other 4 Rand for growth? Surely company B is more valuable. And that's why we at Prudential look at a whole host of valuation metrics. Obviously, as value investors, we concentrate our efforts on the cheap side of the market, but also we like to overlay a quality screen. Obviously, this is a subjective process. It requires the intervention of humans, but as Warren Buffett forewarned, valuing a business is not just science. There is also a part art to it as well. And what this chart shows is effectively the sad story of African Bank. Time zero here is effectively the date at which that company suspends its dividend, and then we're looking at the price performance 250 days before to 250 days after. The shaded area here is effectively the weight of African Bank in a passive product like Divi Plus. The red line is the dividend yield. So the dividend yield at one point looks very attractive, sitting at about 8%. So Divi Plus effectively buys quite a lot of African Bank. In November 2013, African Bank slashes its dividend. So you would think that the weight in the Divi Plus index would fall. It does, but it only falls about 5 months later because these products are not effectively rebalanced on real time. To keep the turnover costs low, they only rebalance every 6 months. Okay, so even though the dividend is cut in November, effectively only in March of 14 is the weight in Divi Plus actually reduced. Okay, African Bank then again suspends its dividend here in May of 14, again because the next rebalancing date only happens in September, and African Bank effectively goes to the wall in August. Divi Plus is still left holding 1.7% of African Bank when the company is suspended. Most companies, however, that suspend their dividends actually don't go bust. And if they're able to navigate this period of a liquidity squeeze, the subsequent price returns can be quite stellar. So this is actually Anglo-American. They suspend their dividend in February of 16. It falls out of the Divi Plus about 10 days later. But as you can see, the subsequent performance is quite strong. The share price doubles, effectively outperforms the market by 150%. Okay, Divi Plus held Anglo-American here, basically sold it near the bottom, and because Anglo-American hasn't reinstated its dividend, it effectively is no longer in the Divi Plus index. The irony is that this is not the first time actually Anglo-American has suspended its dividend. Okay, it suspended its dividend in 2009, and the return profile was almost identical. You effectively underperformed into the dividend suspension and outperformed thereafter. So the current version of smart beta being pushed in the market isn't even smart enough to contemplate whether 2016 will be a repeat of 2009. Okay, the red shaded area here is how we have traded Anglo-American. So we could argue we also had too much of a weight in Anglo-American over here, although we were able to get out a bit quicker than Divi Plus. But then as soon as we saw that the company wouldn't need to be recapitalized and wouldn't go to the wall, we were able to rebuild our weight in Anglo-American and at least enjoy this uprun for our clients. Okay, so when you put that all together and you compare our funds versus Divi Plus, yes, we have a lower dividend yield than Divi Plus. So our dividend yield on our funds runs at about 4%. Divi Plus is at 5%. But if you look at other metrics like dividend cover, how many times is your dividend covered by earnings, you'll see that our dividends are actually more secure, and also our dividends are forecast to grow much faster than the portfolio of Divi Plus. And therefore, because Divi Plus is looking at the market through a single lens, it's under-indexing on other factors, particularly growth. So, your total return is made up of, yes, it's made up of dividend yield, but also of the growth that you're going to get in that dividend stream. And you can see the 5-year return number from Divi Plus is actually very close to the initial yield. It's only really picking up that yield, and it's foregoing quite a lot of growth, which you're obviously picking up in the Prudential funds. Okay, my last slide for today. Does passive outperform? Who do we hold accountable? Now, if an active manager like ourselves or our competitors behaves in a dysfunctional manner and we underperform either the market or the benchmark that we've been given, we effectively will be fired. Okay, so what I've got here is effectively all the 185 funds in the general equity category, and effectively we will fire all those that don't beat the market. Okay, the question is, who is holding passive to account? A lot of these passive products, once they are launched, don't show you the performance of that product relative to the overall market. They show you the performance relative to the benchmark they are tracking. So if you buy a smart beta product and you get the fund fact sheet, they'll effectively show you how the smart beta tracker has done relative to the smart beta index. But how is that index actually performing relative to the market? Okay, there are currently 7 funds or passive funds, smart beta funds in the market with a 5-year track record. Effectively, none of them have actually been able to outperform the overall market. Okay, lastly, in our view, there is effectively no passive decision. There's different shades of active. Hopefully, if you go for an active manager, you will select Prudential. If you go passive, I think a lot of time and attention has to be placed on which index you are planning on tracking and how those indices are actually performing relative to the overall market. Thank you for your time today.